Hi, Tim Freund, Tim Freund Fine Estates and Homes. I'm a real estate broker here in Southern California. One of the things that we've been talking about is pre-approval, and I want to talk to you about something called debt to income ratio. Now, for those of you who are familiar with this, skip this. This isn't for you. But for those of you who are not familiar with it, debt to income ratio is your debt and your income and the ratio between the two. Sounds self-explanatory, but it's a little bit more complicated. For example, let's say you're purchasing a home and you make $5,000 a month. Let's say $6,000 a month, so it's easy. And the mortgage payment with taxes and insurance is $2,000 a month. So your debt to income ratio, that's 1/3, is 33%. There is another factor, though, that you have to take into account when considering debt to income ratio, and that's your cumulative, your aggregate debt to income ratio. And that's taking the mortgage, taxes, insurance, etc. against your income, but also adding in all your other debt. So this becomes particularly important with our millennial buyers who have student loan debt. You've got to factor in the payments for the student loan. If you have a car payment, you have to factor in the car payment. If you have alimony or child support, you have to factor those types of things if you have a lot of credit card debt. So you can see that there's an equation that can get quite complicated. Now, sometimes they can knock off some of the debt, won't necessarily count against your debt to income ratio, depending on your career choice, depending on your, what type of debt it is. So certain professionals have a break there, doctors and such like that. But the main thing is that when you're getting that pre-approval, that your debt to income ratio stays within the range that a lender is willing to allow. In other words, a lender is not going to let you have 100% debt to income ratio, right? 100% of your money is going to go to service the debt. That's not going to happen. In fact, when you're dealing with a jumbo loan, which would be, depending on your county, it could be well over $1,150,000. If big loan, you can actually only go up to 42% of your total income can be consumed by debt, which is the mortgage and then also your other debt. Conversely, if you're in a Fannie Mae or Freddie Mac program, a conventional loan, you can actually go up to 50%. So it can be quite a bit, quite advantageous if you're in a conventional loan structure versus, say, a jumbo loan structure. And again, it comes down to your down payment and your purchase price. So that's debt to income ratio in a nutshell. Feel free to DM me if you have any questions. Thanks.